Welcome to The Explainer. Today, we're breaking down a pretty unique investment vehicle, the NEOS Boosted Nasdaq 100 High Income ETF. You'll see it under the ticker symbol XQQI. And to really get what makes it tick, we're diving right into its prospectus to see how it works. So, let's kick things off with a big question for a lot of investors right now. How can you get in on the growth of those huge tech names in the Nasdaq 100, but also generate a really solid regular paycheck from it? It usually feels like you have to pick one or the other, growth or income. Well, this ETF claims you don't have to choose. And that's exactly where XQQI enters the picture. It's built from the ground up to try and tackle both of those goals at once, giving you that high monthly income while still keeping you in the game to capture the upside when the tech market is climbing. Let's see how the fund officially describes its mission. Right there in the description, you see two huge promises. First, generating high tax-efficient monthly income. We love to see that. But second, and this is really important, is the potential for enhanced equity appreciation. That word enhanced is the secret ingredient here, and it's what sets this ETF apart from the crowd. So this brings us to what they call the boosted engine. See, XQQI isn't just trying to copy the Nasdaq 100. It's actually trying to amplify its exposure to it. So how on earth does it get that boost? The whole strategy really has two main layers. First, you've got the foundation. The fund goes out and buys the actual stocks in the Nasdaq 100, just like a regular index fund would. But then it adds a second layer on top, using what's called a synthetic option strategy to get even more exposure. Now, I know options can sound super complicated, but the goal here is actually pretty simple. By buying certain options and selling others on the Nasdaq 100 index, the fund basically mimics the effect of owning more of the index. Think of it like using financial tools to get more skin in the game without having to buy all the extra stock directly. So here's the number that matters, the big takeaway from all this. When you combine the actual stocks they own with that extra synthetic exposure from the options, the fund is designed to have roughly 150% exposure to the Nasdaq 100. It's kind of like having $1.50 working for you in the market for every $1 you put in. Okay, but that 150% exposure isn't just about chasing bigger gains. It's also the very engine that powers the fund's other huge promise, that high monthly income we were talking about. It all comes down to a strategy called writing covered calls, but they're doing it on steroids. The fund sells call options against its entire 150% exposure. That means against the stocks and the synthetic position. And for selling those options, it collects cash payments, which are called premiums. That cash is the main source of the high monthly distributions that get paid out to you, the investor. And the fund is very upfront about the trade-off here. The prospectus itself says that this strategy is all about converting a piece of the potential future gains into cold, hard cash flow today. You're basically agreeing to trade some of the potential for a massive home run in exchange for getting paid consistently right now. And the income they're aiming for? Well, it's pretty ambitious. The fund states an aspirational goal of a 19 to 23% annualized distribution rate. Now, let me be super clear here. This is a goal. It is absolutely not a guarantee. It's based on the performance of a similar fund, and the actual payouts are going to change with what the market is doing. But it's not just about how much income you make. It's about how much you get to keep. And that brings us to another key feature of this fund, its tax efficiency. The secret sauce here is a special part of the U.S. tax code called Section 1256. The specific index options that the fund uses get this special treatment from the IRS. So unlike the gains from a lot of short-term trading, which get taxed at your highest income rates, the money from these options is treated way more favorably. And here's the bottom line, the real benefit. All the gains and losses from these options are taxed at a blended rate. 60% is treated as a long-term capital gain and only 40% as short-term. And that happens no matter how long the options were held. For most people, this mix can lead to a much smaller tax bill compared to other kinds of investment income. All right, we've talked about the potential upside. But of course, any strategy that shoots for high rewards is going to come with some pretty significant risks. To really make an informed decision, you absolutely have to understand the critical trade-offs that are baked right into this ETF's DNA. There are really two big ones to watch. First is leverage risk. It's the flip side of that boost. Just like gains can be magnified, so can losses. If the market takes a nosedive, this fund could lose value even faster than the index itself. The second risk is what's called an upside cap. The very strategy that generates all that income, selling call options, also puts a ceiling on your potential gains. If the Nasdaq 100 goes on an absolutely epic rally,
This fund is designed to miss out on some of that upside.
And that really brings us to the final question, the one you have to ask yourself. When you think about your own financial goals, your own tolerance for risk, is that potential for boosted, tax-friendly income worth the trade-off? Is it worth accepting magnified risk on the downside and a cap on the upside? That's really the core dilemma you have to solve with XQQI.